Good morning, good afternoon, good evening. Hello, it's Dr. Dabowski again. Welcome back to another video for Module 2. This is Chapter 8, Liabilities. I'm going to go through some of this kind of quickly, but it's some quick background information on liabilities. This chapter is kind of one of the easiest chapters probably that you'll have to deal with. But there is a few areas, specifically with contingent liabilities and product warranty liabilities that I believe warrant some special attention. So let's go ahead and take a look at what we're going to look at here. So now I want you to think of the fact that in this course in Chapter 8, we're kind of flipping the coin and we're moving on to the liability side of the balance sheet. In this particular case, we're going to be dealing with purchasing on account, which would require us to set up an accounts payable liability. We're going to be dealing with the expense side of the coin and the purchasing side of the coin and the payable side of the coin. Prior to this point, we've been focusing on the selling side of the coin, the servicing side of the coin, where we're dealing with the receivable and revenue. So if you could think of what side of the coin you're on, it's very helpful in analyzing transactions. So let's talk about basically about the most important thing about what are the characteristics of a liability. We know an asset is something that possesses future economic benefit. Okay, liabilities have three essential characteristics that you need to be aware of. Number one is that they have probable future sacrifices of economic benefits. So that makes a lot of sense. Think about, again, look at the terminology. It's a future sacrifice of an economic benefit. What's an economic benefit? Right? It's an asset. So think about your own personal lives. What economic benefit or asset do you think is sacrificed when you settle a liability? Think about your own personal lives. When you pay your utility bill, pay your cell phone bill. Correct. Cash is likely the economic benefit. The cash asset is sacrificed. Also, it has to arise from present obligations to other entities, and it must result from past transactions or events. These are three key ingredients of what characteristics of liabilities are. In most cases, our current liabilities are obligations that are payable within 1 year. Remember, something is current if it's 1 year or less. It's long-term if it's greater than 1 year. Long-term liabilities are obligations that are payable in more than 1 year. And we're going to deal with those in another short video that deals with the pricing of bonds or issuing of long-term debt. But in this particular case, in this video, we're focusing on short-term liabilities. If we think about what a notes payable is, it's a liability. It has the word payable, but the word note tells you that it's longer term, generally signed, and contains some type of annual percentage rate, interest rate attached to it. Generally, notes payable are typically bank borrowings with promises to repay the amount borrowed plus some amount of accrued interest. Let's assume on August 1st you borrowed $12,000 by signing a 5% 6-month note. So let's see what happens on August 1st. When you borrow the money, look what happens, y'all. Remember, borrow is a sight word. It means your liabilities are going to go up, and if you're borrowing, your cash is going to go up. So you increase your cash, debit cash, credit and notes payable for $12,000. Now, you get down to December 31st, right? And now what's happening? We have that key. Remember, you see the word December 31st. It means what? Adjusting entry. Since you borrowed, you're going to have to pay interest expense back to the bank. So that means you're going to have to accrue some interest from August to December 31st. So in that case, you're going to go ahead and debit interest expense, which is going to be the principal, $12,000, times rate 5%, times 5 over 12, August, September, October, November, December. Use your fingers. Remember, the fraction is always denominator is 12, and put the number of months that you're accruing for in the numerator, 5 over 12. Interest payable, remember it's a liability, so we'll call it interest. On February 1st, the note matures. So now what happens on the maturity date? You have to pay back the principal and all of the interest. So you're going to go ahead and debit the notes payable, because up here on August 1st you set up a notes payable, but you're paying it back now. You're going to go ahead and take care and clean up your balance sheet from the adjusting entry on December 31st. Now you're going to have another what? Another month's worth of interest from December 31st to January 31st. So you're going to debit your interest expense. Notice that these two add up to 6, and that's how much of a note it is. It's a 6-month note. And then finally, you'll just close it out with a credit to cash for $12,300. There's other current liabilities, so if we purchase merchandise or services on account, we're going to use a liability called accounts payable. Deferred revenue, we've talked about that when we receive cash in advance prior to performing the service. Sales taxes payable, or when the company has to accrue and allocate sales taxes from every sale. So if there was an 8% sales tax, the company would collect on a $100 sale, 108 from the customer. It would set up a sales tax liability for the $8 of sales taxes, and its revenue would only increase by the $100. So we don't include the 8% sales tax as revenue because we have to just pass that through onto the state government. And then the current portion of long-term debt is also a current liability that represents the 12 months principal payments. So when a portion of long-term debt, such as a mortgage, becomes payable within 1 year, it is reclassified on the balance sheet as a current liability. Now let's speak about the really one basic bucket of liabilities, special type, called contingent liabilities. This is where the existence of the liability is uncertain. Also, the amount of the liability is uncertain, and the existence and the amount depend on some future events. A good example of a contingent liability companies face is a lawsuit against the company. If the company wins, no payment is made. If the company loses, payment is made. Contingent liabilities are recorded if the payment is both probable and the amount is reasonably estimatable. Contingent liabilities are only disclosed if the payment is just reasonably likely, and contingent liabilities are not disclosed if the payment is what we call remote. So let's look at these three classifications and likelihoods of a loss. If it's remote, right, so the two things we want to first understand is, what does it mean to report something in the financial statements? It means to record it. What does it mean to discuss it in the footnotes but not to record it? It means disclosing. And we look at our likelihoods of losses. If it's remote, we neither record nor disclose. If it's reasonably likely, we do not record it. We don't report it in the financial statements. We just discuss it in a footnote. If it's probable, however, we both record it, report it in the financial statements, and disclose it or discuss it in the footnotes. Let's look at a contingency example. Company A is suing Company B for $10,000. Company A feels that it is probable that it will be awarded the full amount. Company B feels it is probable that it will not have to pay A anything. What entry would Company A record? Think carefully. A is suing B, but A feels that they're going to be awarded, or that it's probable they will be awarded the full amount. Careful here. This would result, if Company A is successful, they would have a gain, right? If they win the lawsuit. And the problem in accounting is that we don't record gain contingencies. Be very careful, because that would be not conservative. We don't recognize gains. We recognize losses, anticipate losses, record all losses, but we don't anticipate gains. That violates the conservatism principle. So no entry would be recorded because we don't record gains contingencies. How about Company B? If it feels it's probable it won't have to pay anything, it would have to make no entry either because the loss is not probable. Let's turn this around. Let's assume that B feels that it will be probable that it will have to pay A the full amount. What entry will A record? Again, same scenario. A will not ever record a gain contingency, so no entry. B, on the other hand, now feels it's probable they're going to lose, so conservatism would say record all losses. And so under the requirement that it's probable, they would have to disclose it and record it. So they would debit a loss, which is the same as an expense. Stockholders' equity goes down for $10,000 and set up a contingent liability, which is a lawsuit liability for $10,000. On the basic accounting identity, we could see that liabilities go up and stockholders' equity goes down by a similar amount because of the loss here, which reduces stockholders' equity. So everything zeroes out on the right side. This is a valid entry. Now let's look quickly at warranty liabilities. A warranty liability is the amount of the liability must be estimated. Most companies offer a warranty on products sold. By doing this, the company obligates itself to perform services if the product becomes defective during the warranty period. It is likely that at least one product will become defective, then the existence of a liability is what we refer to as certain. The obligation and therefore the related expense must be recorded in the period the sale is made. Also allows the expenses to be matched with the revenues they help to produce. You should listen and hear the matching principle in that bullet. And the precise number of products will become defective is not known, but we can estimate it. Let's look at a warranty example. A company sells mixers for $300 and offers a 1-year warranty. During the year, 500 mixers are sold. On December 31st, adjusting entry date, the company estimated that 2% of the mixers will need to be repaired next year, and the average cost per mixer repair will be $80. On December 31st, what will the company do? Well, number one, it's going to estimate a warranty expense of $800. It gets that for the 500 units times the 2% times the $80 per estimated repair per blender mixer would give us $800. So we would hit an expense and we would set up a warranty liability. Next year, 8 mixers were fixed for a cost of $700, which included $300 per parts inventory and $400 for labor. So now we have this liability sitting here, but we now have the actual repairs coming through. So we will simply apply these repairs against the liability we've already established in a prior period. We'll debit the warranty liability for $700. We're going to relieve our parts inventory for $300 because we used our own parts to make the repairs. And then the labor, we're just going to go ahead and credit our cash because we paid $400 to our laborers to go out and make the repairs. And this would be a way we would settle the liability. Notice that we made an estimate that we thought $800 would be required, but so far we've only realized $700 of warranty repairs against that $800 liability. Let's look at a real company example. How does Ford report its warranty liabilities? Ford Motor. Notice that warranty costs accruals are the costs for basic warranty coverages and product recalls and products sold. Let's look at 2014. Look at the beginning balance of Ford's warranty liability, and this is in millions of dollars, so add 6 zeros onto this number. They come into the year with about $4 billion worth of warranty liabilities, the estimated amount. However, the payments they made against that liability during the year only amounted about $2.8 billion, so they had sufficient reserve there to cover these. They made changes to existing product warranties during the period, and at the end of the period they had $4.786 billion of warranty liabilities for future warranty claims on their balance sheet. This is a big number. This is material. Well, thank you for listening to this video on liabilities. I hope that you found it useful. Have a great day, everyone.